I've noticed some active discussions on YouTube and investment forums about whether income or growth investing is better. For those of you who are new to investing, you may not know the difference between the two. Let me quickly explain them in layman terms. Income investing is when you invest in companies that regularly pay dividends, giving you a steady income. On the other hand, growth investing is when you invest in companies that are expected to grow significantly, which usually means their share prices will go up. Your profit comes from selling the shares at a higher price than what you paid for them. In my opinion, companies listed on the Singapore Exchange are better for income investing, while companies listed on the US Stock Exchange are better for growth investing. In today's video, I will be walking you through some of the benefits and drawbacks of both income as well as growth investing, and also help you figure out which one might be more suitable for you. Here are some of the benefits of income investing. One of the biggest benefits of income investing is that it provides one with a steady income through dividends. This extra money can be very useful. You can reinvest it to grow your portfolio, use it for everyday expenses, or spend it on things you enjoy. Continuing from the first point, if you choose to reinvest the dividends you receive back into the same dividend-paying companies, it can greatly boost your long-term returns thanks to compounding. This reinvestment can lead to significant growth of your investment portfolio over time. Generally, dividend-paying companies are more well-established and financially stable, which means their share prices are less likely to experience drastic ups and downs. Many companies that pay dividends, particularly those in a good financial position, they often raise their dividend payouts over time. These increases can help combat inflation by giving you a growing income, which helps to keep or even boost your buying power. And finally, it is important to know that as a Singaporean investing in companies that pay dividends, you do not have to pay taxes on the dividends you receive. But do take note that if you invest in companies listed in the United States Stock Exchange, the dividends you receive will have a 30% withholding tax taken out of them. This means you will receive 30% less than the amount that the company announces. Next, let us look at some of the drawbacks related to income investing. Companies that pay high dividends usually do not see a big increase in their share prices. So, if you are looking to invest in companies that will grow a lot in terms of its share prices, these might not be the best choice compared to growth companies, which I will be talking about in the later part of this presentation. Economic downturns, high interest rates, and unfavorable currency exchange rates can affect a company's ability to increase its dividend payouts. For example, with the current high interest rates environment, many REITs or real estate investment trusts for short are struggling to keep up with their dividend payouts because their borrowing costs have gone up. Companies can change their dividend policies, which can make the income from dividends less predictable. For instance, in the year 2020, the Singapore Exchange changed its reporting requirements from quarterly to half-yearly. As a result, many REITs have switched their dividend payouts from quarterly to half-yearly. And as shareholders, we could not do anything about it. And finally, if dividends do not grow as fast as inflation, the value of your dividend income can decrease over time, which means money will not be able to buy as much as it used to. Moving on to growth investing, here are some of the key benefits. Growth companies often see their share prices shoot up quickly as they gain more market share, create new products, or expand into new areas. Investing in these stocks for the long term can lead to significant wealth because the returns build up on themselves over time. Many growth stocks, especially when they are just starting out, are very affordable for everyday investors like you and me. This means you do not need a lot of money to start investing in them. Another benefit of growth investing is that many of these growth companies have a broad global presence, which helps spread out the risk of relying on income from just one country. This diversification helps protect our investment. Here are some of the drawbacks of growth investing to highlight. The share price movements of these growth companies can be very unstable. They can drop sharply during bad market conditions or if their financial performance fail to match investors' high expectations. Most growth companies pay out very little or no dividends as they prefer to reinvest their earnings back into the company to grow faster and bigger. There isn't a one-size-fits-all answer for whether you should focus on income or growth investing. It really depends on what you want from your investments and, most importantly, your comfort level with risk. If you prefer to play it safe and don't like taking big risks, you will probably lean towards income investing, as these investments usually have steadier prices and you will also receive dividends on a regular basis. On the other hand, if you are okay with taking bigger risks for the chance of potentially higher rewards in terms of huge capital appreciation in time to come, then growth investing may be more exciting for you. Last but not least, no matter which investment strategy you choose, income, growth, or a mixture of both, always make sure you thoroughly research any company before investing your hard-earned money. Speaking of which, I have made a video called How to Tell If a Company is Worth Investing In 2 weeks ago. You can find the link to it in the description below. With that, I have come to the end of my video post today to share the pros and cons of each, along with what may be more suitable for you. If you have any questions for me, you can either let me know in the comments section below or you can drop me an email. You can find the link to do so in the video description below. Finally, if you like what I have just shared, I would greatly appreciate it if you can give me a like. Thank you for watching, and I look forward to talking to you again in the next video.